You don't blow your account because of bad trades. You blow it because of bad entries. Long before your stop loss gets hit, long before you panic and close in fear, the damage is already done. The moment you click buy or sell, you've either aligned with professional process or you've handed your money to someone who has. And until you understand this distinction, your equity curve will always look like a heart attack monitor, up, down, and eventually, flatline. Here's the expensive lie you've been sold by every guru, chat room, and signal service, that finding setups is the secret to trading success. It's not. The secret is rejecting setups until only the surgical ones remain. Most traders are hunting for reasons to get in. Professionals are hunting for reasons to stay out. This isn't a subtle difference. This is the difference between feeding the market and extracting from it. Think about how you've probably been conditioned. Scan for patterns, scan for indicators, scan for signals. Bull flag, enter. Rusi oversold, enter. Support level, enter. Every flicker on the chart becomes an invitation. Every candle whispers opportunity. Your brain gets addicted to action because it feels like progress. But in trading, action is not progress. Action, when it's not grounded in a repeatable entry model, is just refined gambling with better charts. By the time most amateurs hit the buy button, the professional has already decided to pass. The amateur sees opportunity everywhere. The professional sees traps everywhere. This isn't pessimism. It's precision. The professional isn't trying to trade more. He's trying to trade cleaner. Fewer entries. Higher quality entries. Surgical entries. Here's the brutal math that nobody wants to discuss. 90% of your potential trades should never be taken. Let that sink in. 9 out of 10 ideas that flash in your brain, 9 out of 10 charts that look good, 9 out of 10 alerts that ping your screen should be completely rejected. Not traded smaller. Not tested with a little size. Discarded entirely. Your edge isn't in spotting moves. A child can spot a green candle breaking resistance. Your edge is in saying no to everything that doesn't pass through 5 specific gates. Jesse Livermore, one of the greatest speculators in history, didn't make his fortune by trading every day. He wasn't chasing every wiggle in the tape. He made it by waiting for what he called the big swing, when all conditions aligned and the tape screamed confirmation, not whispered suggestion. Picture this scenario. 2 traders are watching the same breakout on a Tuesday morning. A stock has been consolidating around $50 for 2 weeks. Suddenly, a green candle spikes to $50.50. The amateur sees price moving and feels his chest tighten. His pulse quickens. The fear of missing out, that ancient biological panic, kicks in. He thinks, I need to get in before I miss it. His mouse hovers over the buy button. There's no real plan, no defined risk, just an emotional clock ticking down in his head. He clicks buy and immediately feels relief, followed by anxiety. The professional sees the same breakout and feels nothing. No urgency. No fear of missing out. No rush to participate. His internal monologue is radically different. He thinks, show me why this is different from the last 10 failed breakouts. Where is the volume? Where is the context? Where is the confirmation? He remembers every time price faked out above a level, trapped chasers, and collapsed. He leans back in his chair. He waits. He demands that the market prove itself to him. Same chart. Different mind. One is trading price. The other is trading process. Let me tell you what happens next, because this is where fortunes diverge. The amateur is now mentally held hostage. His heart rate has increased. His eyes are locked on the screen. Every tick against him feels like a personal attack. Every tick in his favor feels like validation. He's no longer analyzing the market. He's defending his decision to enter. This is the hidden cost of bad entries. They don't just lose you money when they fail. They corrupt your judgment while you're in them. The professional, still watching, sees the breakout stall. He sees volume drop off. He sees the second candle close lower than the first. He notes this in his mental database. Another failed breakout, just like the previous 10. His capital is still intact. His emotions are still neutral. He's still hunting. The amateur is now hoping, praying, rationalizing why the trade will still work out. This is where identity separates the two. Amateurs define themselves by being in the market. They think the more often they trade, the more of a trader they are. If you sit at your desk doing nothing for 6 hours in a normal job, you get fired. In trading, if you sit at your desk doing nothing for 6 hours because the market offers no edge, you are doing your job perfectly. That is the hardest psychological shift you will ever make. Professionals define themselves by their discipline. They know waiting is a position. Flat is a position. Cash is a position. They treat their capital like an elite soldier treats his ammunition. They don't spray bullets into the dark hoping to hit something. They wait for a clear target. Consider the real cost of a bad entry. It's not just the money you lose on the stop loss. That's actually the cheap part. The real cost is the emotional capital you burn, the opportunity cost that compounds. While you're distracted by this garbage trade, sweating every tick, the perfect A+ setup forms on another chart, and you miss it because your capital and your focus are tied up in mediocrity. Here's what nobody tells you about trading education. Every course, every book, every YouTube video focuses on teaching you patterns. Head and shoulders, bull flags, cup and handle. They teach you to recognize setups. But recognition is the easy part. The hard part, the part that separates the survivors from the statistics, is knowing which patterns to ignore. The market is a mechanism for transferring wealth from the impatient to the patient. Every time you enter a trade prematurely, you are voluntarily donating your money to someone who waited 5 minutes longer than you did. You are not losing because the market is rigged. You are losing because your filter is broken. Right now, if you're like most amateurs, you're taking 30, 40, maybe 50 trades a month. You're busy. You're active. You feel like a trader. But your win rate is probably around 50%, maybe less. Your average winner is smaller than your average loser because you cut winners too early and hold losers too long. Your account is going nowhere or slowly bleeding. Now imagine taking 5 trades a month. Just 5. But each one has passed through all 5 gates. Each one has context, confirmation, volume, proper position sizing, and a clear exit plan before you enter. Your win rate jumps to 70% because you're only taking the highest probability setups. Your average winner is larger than your average loser because you're entering with the trend, not against it. Your account starts compounding. That's the difference between hunting and filtering. The amateur thinks more trades equal more opportunities. The professional knows fewer trades equal more edge. You're about to learn a 5-gate entry model that transforms trading from gambling into surgical precision. This isn't a list of indicators. It isn't a magic pattern. It is a filtration system. Think of it like a security checkpoint at a high-stakes facility. Each gate is a filter. Price must pass through all 5, or you don't trade. No exceptions. No, just this once. No overrides based on gut feelings or fear of missing out. Each gate exists because traders before you lost money by skipping it. Each gate costs you opportunities. That's the point. You want to lose opportunities. You want to say no 90 times, so you can say yes 10 times with full conviction and proper size. This requires a level of discipline that most people simply don't possess. Most people want the dopamine hit of being in the market. They want the action. They treat the market like a casino, and the market treats them like a gambler. It takes their money. The first gate requires you to do absolutely nothing, and it's the hardest thing you'll ever master in this business. It sounds easy, doesn't it? Just doing nothing. But when the market is moving, when the bells are ringing, when social media is buzzing about new highs, doing nothing is torture. It requires you to suppress your ego. It requires you to kill your need for excitement. Because in trading, boring is profitable. Excitement is expensive. Before we open that first gate, you need to understand why most traders skip the foundation entirely. They skip it because they're addicted to the prediction game. They look at a chart and say, I think this is going up. The market doesn't care what you think. The market only cares about supply and demand. The professional doesn't predict. He reacts. He waits for the market to tip its hand. He lets the market go first. The amateur tries to front-run the move. He tries to buy the exact bottom. The professional is happy to miss the first 10% of the move. He gives that up willingly. Why? because that first 10% is where the risk is highest. That's where the noise lives. He waits for the trend to establish itself, for the probability to shift in his favor. This 5-gate model is designed to protect you from yourself. It's a set of handcuffs you wear voluntarily. It prevents you from overtrading. It prevents you from chasing extended moves. It forces you to align with the dominant psychology of the market. When you use this model, you will trade less, much less. You might go 3 days without taking a single trade. At first, that will feel uncomfortable. You'll feel like you're missing out. But then you'll look at your account balance at the end of the month. You'll see that the slow bleed of small losses has stopped. We're going to dismantle your current approach and rebuild it from the ground up. We're going to strip away the noise, the indicators, and the confusion. We're going to replace them with a cold, hard process. But be warned, this process is simple, but it's not easy. It demands that you become boring. The first gate is right in front of you. It's the gate of context. And most of you are crashing right through it without even looking left or right. Let's change that right now. Gate 1 is the stalk, and it requires zero capital but maximum discipline. This is where most traders fail before they even place their first order. They fail not because they lack knowledge of patterns or indicators, but because they fundamentally misunderstand what professional trading actually looks like. They think trading is about constant action, constant positioning, constant engagement with the market. The professional knows that trading is about selective inaction, punctuated by moments of surgical precision. Most amateurs believe they must be in the market to be traders. If they're sitting in cash, they feel like they're wasting time. They feel unproductive. They feel like they're missing opportunities, while other traders are making money. This psychological need to be constantly engaged is their fatal flaw. The professional understands something completely different. Cash is a position. Cash is not sitting on the sidelines in fear. Cash is not being lazy. Cash is being ready. Cash is ammunition waiting for the perfect target. During the stalk, you are a sniper waiting for the wind to die down. Think about how a professional sniper operates. He doesn't run onto the battlefield firing wildly at anything that moves. He lies in position for hours, sometimes days. He studies the terrain. He watches the wind patterns. He observes his target's behavior. He notes the lighting conditions. He might have a perfect shot opportunity, but if the wind is wrong, he doesn't take it. He waits. Is he failing? No. He is executing his process perfectly. He understands that one perfect shot is worth more than 100 rushed attempts. You observe without engagement. You study without commitment. You build a mental map of the market's behavior without risking a single dollar. This is the hardest psychological shift you will ever make in trading, because it requires you to suppress your need for action and embrace the power of patience. Here's exactly how this plays out in real time. Let's say you're watching a technology stock that's been consolidating between $48 and $52 for 3 weeks. Every time it approaches 52, sellers appear and push it back down. Every time it drops toward 48, buyers step in and support it. The stock has been boring, choppy, going nowhere. Most traders have moved on to more exciting opportunities. Then, on a Tuesday morning at 10:15 a.m., the stock breaks above $52. It hits $52.40 on a green candle with expanding volume. The amateur who's been watching sees this breakout, and his brain immediately screams entry. He's been conditioned by every trading book, every YouTube video, every chat room, to recognize breakouts as bullish signals. Consolidation breakout. Resistance becomes support. Volume confirmation. He knows all the terminology. His finger hovers over the buy button. His heart rate increases. The fear of missing out kicks in. He clicks buy at $52.50. The professional sees the exact same breakout, the exact same green candle, the exact same volume spike. But his first thought is not entry. His first thought is context. He doesn't get excited. He doesn't feel urgency. He asks himself a systematic series of questions that must be answered before he even considers risking capital. First question: what's the dominant trend on the higher time frame? He zooms out from the 5-minute chart to the daily chart. He sees that this stock has been in a 6-month downtrend. Yes, it's been consolidating for 3 weeks, but that consolidation is just a pause in a larger decline. The context is bearish. This breakout is happening against the dominant trend. Second question, where is this breakout in relation to pivotal levels? He looks left on the chart. He sees that at $55, there's a massive resistance zone where the stock was rejected 3 times over the past year. So even if this breakout is legitimate, it only has $2.50 of upside before it hits a brick wall of institutional selling. The risk-reward ratio is poor. Third question, what's the broader market environment? He glances at the S&P 500, the NASDAQ, the sector ECF. The market has been chopping sideways for 2 weeks, with no clear directional bias. There's no tailwind. The overall environment is neutral at best, potentially hostile at worst. Fourth question, is this a trending environment or a ranging environment? He looks at the recent market structure. He sees failed breakouts, whipsaw moves, and mean reversion behavior. The market is in a ranging, choppy phase where momentum strategies get punished and breakouts frequently fail. Within 60 seconds, the professional has systematically rejected this trade. He never calculated position size. He never set a stop loss. He never got emotionally invested. The amateur, meanwhile, is now holding a position, watching every tick, hoping the breakout continues. His capital is at risk. His emotions are engaged. His judgment is compromised. The professional's Gate 1 protocol is non-negotiable. It's a systematic checklist that must be satisfied before moving to Gate 2. First, identify the dominant trend on your chosen time frame. If you're day trading, what's the trend on the hourly or daily chart? If you're swing trading, what's the trend on the daily or weekly chart? If there's no clear trend, there's no directional edge. Trend is the tide. You can fight it, but you'll exhaust yourself and go nowhere. Second, mark the pivotal levels that matter. Jesse Livermore called these pivotal points the major support and resistance levels where institutions do business. These aren't arbitrary lines drawn by retail traders. These are price levels where supply and demand have historically shifted. Prior highs and lows, psychological round numbers, major moving averages. If you're buying a breakout and there's massive resistance 2% above your entry, you're not trading with edge. You're trading into a wall. Third, assess whether this is a trending or ranging environment. This is crucial because trending markets reward momentum strategies while ranging markets punish them. In a strong trend, pullbacks are buying opportunities and breakouts continue. In a range-bound market, pullbacks reverse and breakouts fail. If you try to trade breakout strategies in choppy, sideways markets, you will bleed your account to death through 1,000 small cuts. Fourth, make a binary decision. Am I hunting longs, hunting shorts, or staying flat? This isn't a daily decision. This is an ongoing assessment based on market structure and your edge. If the market is in a strong uptrend, you should be biased toward long positions. That doesn't mean you only take longs, but it means you're extremely selective with short positions. You trade with the path of least resistance, not against it. Context is everything. Your favorite pattern flags, triangles, breakouts, reversals means absolutely nothing if you ignore where it forms in the bigger picture. Think of it like building a house. You can have the most beautiful architectural design, the finest materials, and the most skilled craftsmen. But if you build that house on quicksand, it will sink. If you build it on solid bedrock, it will stand for generations. The pattern is the house. The context is the foundation. A bullish flag in a downtrend is often a trap. It looks textbook perfect. The pattern recognition software lights up green. But the larger trend is down, which means this flag is just a brief pause before the next leg lower. You're fighting the dominant force. A bearish flag in an uptrend is often noise. Yes, the pattern broke down. Yes, it triggered your short signal. But the larger trend is up, which means this breakdown will likely get bought by institutional money looking for better entry points. Let me give you a real-world example of how context saves you money. In early 2022, the NASDAQ was in a clear downtrend. Every rally was getting sold. Every breakout was failing. Every support level was eventually breaking. The context was unambiguously bearish. Yet every week, retail traders were buying dips, buying breakouts, buying oversold bounces. They were pattern trading in a vacuum, ignoring the context. They saw a bull flag and bought it because bull flags are supposed to be bullish. They saw an RC oversold reading and bought it because oversold is supposed to bounce. They saw a support level holding and bought it because support is supposed to hold. They were mechanically following patterns without considering the environment. The professionals were doing the opposite. They were shorting strength. They were waiting for rallies to fail and then adding to short positions. They were stalking the market with a bearish bias because the context was bearish. When a stock broke out to the upside, they didn't chase it. They watched it fail at the next resistance level, and then they shorted it. The context told them which side of the market to be on. By the time the Nasdaq finally bottomed in October 2022, the amateur pattern traders had been chopped to pieces for 9 months. They kept fighting the trend. They kept buying dips that kept dipping. The professionals had either made substantial money on the short side or preserved their capital by staying flat during the most treacherous periods. When the context finally shifted bullish in late 2022, they were ready. They had capital. They had emotional energy. They had their discipline intact. If there's no clear trend, there's no trade. If the context is wrong, even perfect execution of the other 4 gates won't save you. You can have flawless entry timing, excellent position sizing, beautiful pyramiding technique, and perfect stop-loss management. But if the context was wrong from the beginning, the trade was doomed. You were swimming upstream against institutional money flow. Here's the maxim you must internalize. If the context is wrong, the entry cannot be right. Write that down. Tape it to your monitor. Burn it into your subconscious. Because every time you violate this rule, you will pay for it. Not sometimes. Every single time. This is where the psychological warfare begins in earnest. Because now you're not just randomly watching charts. You're systematically evaluating high-probability environments. You're building a watch list of stocks that pass gate 1. Your adrenaline starts to rise. Your fear of missing out begins to intensify. The setups are forming. The context is aligning. And you have to maintain the discipline to continue waiting for gates 2 through 5. Most traders crack at this stage. They've done the hard work of identifying good context. They've found stocks in uptrends approaching support. They found sectors showing relative strength. But then they see a mediocre entry signal, and they convince themselves it's good enough. They talk themselves into the trade. They override their process. They think, just this once, I'll take it even though it doesn't meet all my criteria. And just this once becomes a pattern. And that pattern becomes a blown account. The professional doesn't crack. He's been in this exact situation thousands of times before. He knows that good context creates multiple opportunities. If he misses this particular setup, another one will form. He's not desperate. He's not in a hurry. He's stalking with infinite patience, because he understands that patience is not passive waiting. Patience is active preparation. But understand this critical distinction. Context alone is not permission to trade. Context is only permission to watch. Just because a stock is in an uptrend doesn't mean it won't reverse today. Just because it's sitting at perfect support doesn't mean that support will hold. Just because the sector is strong doesn't mean this particular name will participate. Gate 1 simply opens the door to Gate 2. It tells you, okay, we're in the right neighborhood. The environmental conditions are favorable. Now let's see if price action confirms our thesis. You've identified the hunting ground. You've established your bias. You've defined the context. But you haven't risked a single dollar yet. Gate 2 is where you begin to engage with the market. But you don't plunge in. You don't go all in based on context alone. You probe. You test. You ask the market to prove itself with a small position before you commit serious capital. Because even when context is perfect, even when everything looks right, the market can still reject your thesis. And the only way to survive that rejection is to test first and commit later. That's where we're headed next. The transition from stalking to probing. From observation to engagement. From zero risk to controlled risk. But remember this, without the stalk, without perfect context, everything that follows is just sophisticated gambling. Master the art of doing nothing until there's something truly worth doing. You've passed Gate 1. The context is right. The trend is aligned. The pivotal levels are clear. You're in the right neighborhood, stalking the perfect setup. And this is exactly where most traders commit financial suicide. They see everything aligned, and they go all in. They risk their entire planned position on the first entry. They mistake a green light for a guaranteed outcome. That's not courage. That's arrogance. That's telling the market you know exactly what happens next. You don't. Nobody does. Now comes the hardest psychological shift in trading. You don't go all in. You execute Gate 2, the probe. This is pure Jesse Livermore. The greatest speculator in history never trusted a move just because it looked perfect on paper. He tested. He probed. He asked the market questions with small size before committing serious capital. You enter with 20% of your intended position size. Just 20%. You're not betting on an outcome. You're asking the market, am I right about this? Think of it like testing a frozen lake in winter. You need to cross to the other side. The ice looks thick. The temperature's been below freezing for weeks. Everything suggests it's solid. But you don't sprint to the center. That's how you disappear beneath the surface. You step to the edge. You tap the ice with one foot. You listen for cracking. If it fractures, you step back to shore. You're embarrassed, but you're alive. If it holds, you take one measured step forward. You test with each step. You never commit your full weight until the ice proves itself. Here's exactly how this unfolds. You've been stalking a stock consolidating between $52 and $54 for 3 weeks. It's in a clear uptrend, but trapped in this range. You identify 54 as the pivotal point where sellers have repeatedly appeared. Then, on Wednesday morning at 10:47 a.m., it breaks. The stock surges to $55 on expanding volume. The amateur sees this breakout, and adrenaline floods his system. He's been waiting for this moment. His brain screams, get in before it runs. He calculates his full position, let's say 1,000 shares based on his risk parameters, and clicks buy at 55.10. He's all in. Committed. His entire planned risk is now active. The professional sees the identical breakout. Same volume surge. Same price action. But his response is radically different. He feels no urgency, no fear of missing out. He calculates the same 1,000 share position, but enters only 200 shares at 55.15. His probe is active. He's asking, not betting. Watch the psychology unfold. The stock continues to 55.40. Both traders are green. The amateur is up 30 cents per share on 1,000 shares, $300 of unrealized profit. He's euphoric. He's calculating future riches. His identity is fused to this trade. The professional is up 25 cents on 200 shares, $50 profit. He's not euphoric. He's watching volume. He's analyzing tape behavior. He's gathering data. Then at 11:03 a.m., the stock reverses. A large seller appears. Price drops from 55.40 back to 54.80 in 90 seconds. Now the amateur is up only 70 cents per share. His $300 profit evaporated to $70. He feels sick. His heart pounds. He's thinking, should I sell? Hold, what if this was fake? His position size is too large for his emotional capacity. He's no longer analyzing the market. He's managing panic. The professional is down 10 cents per share on 200 shares, $20 underwater. He's completely calm. His stop is at 53.70, just below the consolidation. If the breakout fails, he'll lose 26 cents per share on 200 shares, $52 total. Insignificant. He's not emotionally compromised. He's still objective. This is the power of the probe. It keeps you rational when the market tests your thesis. But the probe alone isn't enough. You need Gate 3, the proof. This has 2 non-negotiable components, volume confirmation plus follow-through. The breakout must occur on volume at least 20% above the stock's average daily volume. Price without participation is just noise. Volume is conviction. It's institutional money flow. If this stock normally trades 2 million shares daily and breaks 54 on only 1.2 million shares, that's hesitation. But if it breaks on 2.4 million shares, that's commitment. Real money is chasing this move. Second, you need the confirmation candle. The next trading session must close higher than the breakout day. This proves buyers didn't just show up momentarily. They stayed. It proves supply was absorbed, and demand remains aggressive. In our scenario, the stock broke Wednesday and closed at 55.20. Thursday, it opens at 55.30, trades to 56.10, pulls back during the afternoon, and closes at 55.60. The confirmation candle closed higher. The proof is complete. Now consider both outcomes. If your probe fails, the stock breaks 54, reverses, and closes back under resistance, you exit with a tiny loss. Maybe $60 on your 200 shares. Painful? No. Educational. You tested the ice and it cracked. You stepped back. Capital preserved. Emotions intact. The amateur who went full size? He's staring at a $1,500 loss if he exits at 53.60. But he doesn't exit. The loss is too large psychologically. He holds. He hopes. He prays. The stock drops to 52. Now he's down $3,000. He's emotionally destroyed. But if your probe holds and confirmation comes through, price breaks the pivotal point on volume and follows through, the market has validated your thesis. You're no longer guessing. You're aligned with institutional flow. The market answered your question with yes, this move is real. Here's the maxim that will save you thousands. To catch a trend, you must first let it ignore you. The amateur wants to catch the exact bottom tick. He wants maximum profit optimization. The professional happily misses the first 10% of the move. Why? Because that first move is where risk is highest. That's where false starts happen. That's where traps are set. By probing small and waiting for proof, you let the market demonstrate its power first. You let weak hands get shaken out. You let false breakouts reveal themselves. The amateur tries to catch the train as it leaves the station and gets thrown off at the first stop. The professional waits until the train is at full speed, then jumps aboard knowing it's going somewhere. He misses the first mile, but rides it for 50 miles. You've learned to probe with 20% size and demand proof through volume and follow through. You've separated emotion from analysis through position sizing discipline. But now comes the most counterintuitive part of the entire model. Once your probe is validated, once you have confirmation, you must do something that feels completely wrong. You must buy more at higher prices. You must add to strength, not weakness. That's what separates good traders from great ones, the courage to pyramid into momentum when every instinct screams you're buying too high. That's where fortunes are built. That's where Gate 4 takes over. Gate 4 separates the rich from the wrecked. This is where fortunes are built and where most traders psychologically collapse. We're talking about pyramiding strength, and it's the most counterintuitive technique you'll ever attempt to master. Everything in your DNA will fight against it. Every story you've heard about buy low, sell high will scream in protest. That's exactly why it works. Your probe trade is green. You entered 200 shares at $55 after passing gates 1 through 3. The stock confirmed with volume and follow through, and now it's trading at $57. You're sitting on $400 of unrealized profit. This is the exact moment where the amateur and professional part weighs forever. The amateur looks at his green P&L and feels a surge of anxiety, mixed with greed. His brain calculates what $400 could buy. A bill payment, a nice dinner, something tangible. The fear of losing this profit overwhelms him. His inner voice whispers, no one ever went broke taking a profit. He clicks sell at $57.10, banks his $380 after commissions, and feels immediate relief. He posts about his winning trade online. He feels like a trader. But he's just sentenced himself to a lifetime of small gains and mediocre results. The professional does the hardest thing in trading. He adds to the winner. He buys 300 more shares at $57.20, bringing his total position to 500 shares. The amateur watching thinks he's lost his mind. You're buying higher? After it already moved $2? That's chasing. But the professional understands something fundamental that the amateur doesn't. He's not chasing. He's confirming. He's rewarding the stock for proving his thesis correct. This fights every human instinct you possess. You bought at 55. Now you're adding at 57. You're raising your average cost. You're buying something today for more than it cost yesterday. It feels expensive. It feels reckless. It feels wrong. That's precisely why it works. In trading, what feels comfortable is usually unprofitable, and what feels uncomfortable is usually where the edge lives. Here's the psychology you must master. Amateurs want to buy low and sell high. They're bargain hunters looking for deals. They brag about catching the exact bottom tick. Professionals buy high and sell higher. They're momentum hunters who understand that strength begets strength. Why does this work? Because a stock making new highs has a magical property that cheap stocks don't possess: no overhead supply. Think about what this means. When your stock hits 57 and makes new multi-month highs, every single person who owns it is profitable. There are no bag holders praying to get back to break even. There are no trapped longs desperate to escape at their cost basis. Everyone is green, which means selling pressure is minimal. Compare this to a stock trading at $50 that used to trade at 70. Everyone who bought between 51 and 70 is underwater, creating a ceiling of selling pressure. As the price rises, these trapped traders sell into every rally, killing momentum. But at new highs, there's only open sky above. Think of it like a military operation. You sent scouts forward. That was your 20% probe. The scouts report back that enemy lines are weak, and the breakthrough is real. Does the general retreat and celebrate the small victory? No. Does he send the entire army charging in blindly? No. He sends a battalion to secure the breach. That's your 30% confirmation ad. When the battalion reports they've broken through and the enemy is retreating, he pours his remaining forces through the gap to exploit the victory. That's pyramiding, capitalizing on proven advantage with systematic force deployment. The pyramiding protocol is mathematical and non-negotiable. First entry, 20% of your intended position size. That's the probe from gate 2. You entered 200 shares when your full planned position is 1,000 shares. Second entry, 30% after confirmation. The stock proved itself with volume and follow-through, so you add 300 shares. Your total position is now 500 shares. Third entry, 25% on continued strength. The stock breaks through the next resistance level or consolidates and breaks out again. You add 250 shares. Total position, 750 shares. Final entries, smaller increments as the trend extends, maybe 100 shares at the next breakout, 75 shares at another level, 75 more on continued strength. Notice the geometry. It's an inverted pyramid, heavy base, lighter top. You're not adding equal amounts at each level. You're front-loading during the confirmation phase and tapering as the move extends. This ensures your average entry price stays well below current market price. Let's put real numbers on this to make it concrete. You probe with 200 shares at $55. Cost basis, $11,000. The stock confirms and you add 300 shares at $56.20. Additional cost, $16,860. Total position, 500 shares. Average cost $55.72. Total investment $27,860. The stock continues to $58.50 and you add 250 shares. Additional cost, $14,625. Total position, 750 shares. Average cost $56.65. Total investment $2,485. Here's the critical insight. You're not risking more of your original capital. You're using the market's money to leverage your position. When you added that second tranche at $56.20, your initial 200 shares were already up $1.20 each, $240 of profit. Your new risk on the 300 shares, if you set your stop at $55.50, is only $210. But you're controlling $16,860 more of exposure. The market is financing your expansion. This is what Jesse Livermore meant by sitting tight in a big swing. He wasn't talking about holding one static position and hoping. He was talking about building into a position as it proved itself worthy of more capital. You cannot get rich taking small profits on small positions. A $2 move on 200 shares is $400. That pays for dinner. But a $10 move on an average position of 800 shares is $8,000. That's transformational. Let's walk through the emotional journey, because this is where most traders break. You enter your probe at 55. The stock immediately drops to 54.50. You're down $100. It's uncomfortable but manageable because your position is small. The stock recovers, breaks through, and confirms at 57. You add your second tranche of 300 shares. Now you have 500 shares total. The stock pulls back to 56.30. Your second add is underwater. Your stomach churns. The amateur panics. I should have just taken profit at 57. But you hold because your stop is at 54.70 and price is still above it. The stock recovers and breaks to $59. You add your third tranche, 250 shares. 750 shares total now. Your average cost is $57.10. The stock runs to 62. You're up over $3,600. You feel invincible. You add another 100 shares at 62.15. The stock pulls back to 60. Your most recent add is red, but your total position is still up over $2,000. This is the psychological warfare. Every time you add, you create a new entry that gets immediately tested. Weak hands fold. Strong hands understand this is normal price behavior in trending markets. The stock continues to $68. You add your final 75 shares. Your total position is now 925 shares with an average entry around 58.40. You're up nearly $9,000. The amateur who sold at 57 is watching from the sidelines, bitter and confused. How did I miss $11? I was in early. He missed it because he optimized for safety instead of magnitude. He chose the certainty of a small win over the uncertainty of a large one. But here's what you must understand. With every addition, you must move your stop-loss higher. This is non-negotiable. You never leave your original stop in place after pyramiding. That's financial suicide. As you add at 57, 59, and 62, your stop must ratchet up to 56, 58, and 60 respectively. You're locking in profits on earlier tranches while giving the position room to breathe. This way, even if the trend snaps back violently, you don't surrender everything. You might turn a huge winner into a modest gain, but you don't create a catastrophic loss. The maxim is ironclad. Add to your winners, never to your losers. When a trade moves in your favor, the market is telling you you're right. Reward it with more capital. When a trade moves against you, the market is telling you you're wrong. Exit. Don't average down. Don't add to losers hoping for reversals. That's how accounts die. Only positions that are winning the battle get reinforcements. There's a feeling you'll experience when you do this correctly. It's a mixture of terror and exhilaration. You'll be holding 3 or 4 times your normal position size. The P&L swings will be massive. A 0.5% move in the stock will impact your account significantly. Your palms will sweat. You'll have an overwhelming urge to hit the sell button and bank the cash. You must fight this urge. You must let the line run. You must trust the mathematics over your emotions. This is where life-changing money is made. Not in the entry. The entry just gets you a ticket to the game. The pyramiding is how you bet big when you're holding the winning hand. If you have a royal flush, you don't bet the minimum. You push chips into the center. But you only push them because you can see the cards. But every trend ends. Gravity eventually wins. Trees don't grow to the sky. And when you're fully pyramided, sitting on a massive position near the highs of the move, a sharp reversal can be devastating. If the stock crashes 20% overnight, your higher average cost means less cushion than you think. A correction can wipe out months of disciplined gains if you're not prepared. You've built a skyscraper, but skyscrapers sway in the wind. That's where Gate 5 becomes your survival mechanism. It's the exit strategy that ensures you keep the fortune you've built instead of giving it all back in a few reckless days. You've learned to stalk, probe, prove, and pyramid. Now you must learn the hardest skill of all, how to retreat with precision while keeping most of what the market gave you. Because getting out cleanly is infinitely harder than getting in. Gate 5 is the silent exit, and this is where most traders give it all back. They stalk with discipline. They probe with small size. They even catch the big trend and pyramid into it correctly. Then they let greed and hope hijack their discipline at the exact moment it matters most. The silent exit is the difference between seeing big numbers on your screen and actually keeping that money in your bank account. It's the discipline that turns precision entries into lasting wealth. You're fully pyramided. 925 shares with an average cost around $58.40. The stock is trading at $72. You're sitting on nearly $13,000 of unrealized profit. The trend is roaring. Your account balance is the highest it's ever been. This is the most dangerous moment in your trading career, and most traders don't even realize it. The amateur at this point opens his calculator and starts doing fantasy math. If this goes to 80, I'll make 20,000. If it hits 90, 30,000. Maybe I should add more shares? He's already spending money he doesn't have yet. He's buying the boat in his mind, paying off the mortgage in his imagination. His identity becomes fused to that unrealized number on his screen. The professional is doing something radically different. While the amateur calculates upside, the professional calculates exactly where he'll exit if the stock drops 5%. He's not dreaming of $80. He's preparing for $68. The silent exit has two non-negotiable components that must work in perfect harmony: the hard stop and the trailing mechanism. Miss either one and you transform a career-defining trade into a painful lesson about greed. Your hard stop protects against catastrophic ruin. It's placed at the level where your entire thesis is proven wrong. When you first entered your probe at 55, your hard stop was probably at 53.70, just below the consolidation range. That stop said, if price breaks back into the range, the breakout failed, and I was wrong. But as the stock climbed, and you pyramided, that original stop became not just irrelevant, but dangerous. You can't leave your stop at 53.70 when you've added shares at 57, 59, 62, and 65. That would expose your higher tranches to devastating losses. Here's how the hard stop evolves as you pyramid. After your second entry at 57, you move the hard stop to 55.50. This protects your initial probe with a small profit and limits your second tranche to a modest loss if the move fails. After your third entry at 59, you move the hard stop to 57.20. Now both early tranches are protected with profit, and your third entry has limited downside. After your fourth entry at 62, the hard stop moves to 59.50. The pattern is clear. The stop climbs as you pyramid, always staying below your most recent significant entry, but above your earlier ones. Think of it like climbing a mountain. You don't just climb straight up hoping you won't fall. You climb to a ledge, drive a piton into the rock, and clip your rope. If you slip, you only fall to the last piton, not to the bottom of the valley. Each time you add to your position, you're driving a new piton higher up the mountain and securing your gains. But the hard stop alone isn't sufficient for Gate 5. It's your insurance against disaster, but it's too far from current price to protect the bulk of your profits. If you're at 72 with a hard stop at 59.50, a $12 drop would evaporate most of your gains. That's where the trailing mechanism becomes essential. The trailing stop moves up with price, locking in profits as the trend extends. There are multiple ways to implement this, but the principle is identical. You never let a large winner turn into a loser. That's the cardinal sin of precision trading. To watch a $10,000 profit turn into a $2,000 loss because you got greedy is psychological trauma that takes months to heal. Here's one proven trailing method. Use the 20-day exponential moving average as your trailing stop. As long as the stock closes above this moving average, you hold your entire position. The moment it closes below, you exit everything. Why the 20-day? Because it's responsive enough to get you out before major reversals, but forgiving enough to tolerate normal pullbacks in strong trends. A healthy stock can pull back 3 to 5% without breaking the 20-day moving average. But when a trend is truly reversing, the 20-day gets violated with conviction. Another approach is percentage-based trailing that tightens as the position ages. Initially, you might trail 10% from the highest high. As the position matures and you're sitting on substantial profits, you tighten to 7%, then 5%, then 3%. The logic is simple. Early in the trend, you need room for volatility. Late in the trend, when you're sitting on life-changing money, you need to protect gains aggressively, because the risk-reward has shifted against you. Here's the exit protocol in our specific example. Your stock hits 72 and you're up 13,000. You set a trailing stop at 68.40, which is 5% below the high. The stock continues to 76. Your trailing stop moves to 72.20. You're now guaranteed to exit with at least a $12,000 profit, even if the trend reverses sharply. The stock peaks at 78.50 and then pulls back. It trades down to 76, then 74, then 72. Your trailing stop is now at 74.57. The stock breaks below it on heavy volume at 2:47 p.m. on a Tuesday. This is the moment of truth. Every fiber of your being wants to hold. It's just a pullback. It'll bounce tomorrow. I don't want to sell near the low of the day. Your brain starts rationalizing. The weekly chart still looks good. The earnings report isn't for 2 weeks. This is just profit-taking. But your rule is absolute. When price violates the trailing stop or breaks trend structure, you exit. No questions. No hoping. No waiting to see what happens after the close. You click sell and exit 925 shares at 74.20. Your average cost was $58.40. Your profit is $14,630. The amateur who never set a trailing stop? He's still holding, watching the stock drop to 70, then 68, then 65. He's paralyzed by indecision because he never defined his exit criteria. He's hoping for a bounce back to 78 so he can exit at his fantasy profit level. The stock continues to 61. He finally capitulates in disgust, exiting with a small gain on a $23 move because he had no exit discipline. You will never sell the exact top. Never. Trying to exit at the absolute peak is like trying to catch lightning in a bottle. The top only becomes visible in hindsight, and by then it's too late. Your goal isn't to sell the top. Your goal is to sell somewhere in the top 20% of the move while protecting the majority of your gains. If the stock runs from 55 to 78 and you exit at 74, you captured $19 of a $23 move. That's 83% of the total range. That's not failure. That's mastery. The market has changed character. The easy money has been made. You can feel it in the tape behavior. Volume patterns shift. The daily gains become smaller and more labored. The pullbacks become deeper and more sustained. The stock that used to shrug off selling pressure now struggles to hold intraday gains. These are whispers before the scream. The professional hears them and acts. The amateur ignores them and hopes. Let's recap the complete model so you can see how all 5 gates create an integrated fortress around your capital. Gate 1. The stalk. Context before conviction. You identify the dominant trend, mark pivotal levels, and assess the environment. You reject 90% of potential setups because the context is wrong. Gate 2. The probe. Test with small size. You enter 20% of your intended position, asking the market if your thesis is correct, rather than betting on it. Gate 3. The proof. Volume and confirmation. You demand that breakouts occur on heavy volume and follow through with confirmation candles before believing they're real. Gate 4. Pyramiding. Add to strength. Never weakness. As trends prove themselves, you systematically add to positions with decreasing size at each level, using the market's money to compound gains. Gate 5. Silent exit. Let the market take you out. You implement hard stops and trailing stops that remove emotion from exit decisions and protect the wealth you've accumulated. This isn't a get-rich-quick scheme designed to feed your gambling addiction. If you want excitement, go to a casino. If you want dopamine hits, play video games. This is a stay-rich-forever discipline that transforms trading from gambling into surgical precision. It takes the chaos and emotion of market movements and imposes systematic order upon them. The amateur trades on hope and fear. He hopes his losers will recover. He fears his winners will reverse. He's controlled by emotion, which means he's controlled by the market's ability to manipulate that emotion through price action. The professional trades on process and confirmation. He doesn't hope or fear. He executes his system and accepts whatever outcome the market delivers. If his criteria are met, he acts. If they're not met, he waits. He's the rock in the stream while amateurs are leaves blowing in the wind. If you can master the patience to stalk for days without trading and the courage to pyramid when everyone else is taking quick profits, you'll separate yourself from the 90% who churn and burn their accounts. You'll stop being liquidity for institutions and start trading alongside them. But none of that matters if you can't exit with discipline when the music stops. Here's the final maxim that should be burned into your consciousness. Precision is not about being right. It's about being safe. Being right is an ego trip that leads to ruin. You can be right that a stock is undervalued, buy it, and watch it drop 50% before it eventually recovers 3 years later. You were right, but you went broke, waiting to be proven right. Being safe means protecting your capital so you can participate in the next opportunity. It means admitting you were wrong quickly. It means taking partial profits. It means respecting the market's power to destroy accounts. Cut your losses fast when your thesis is invalidated. Size small at the start, so mistakes are cheap tuition rather than account killers. Wait for confirmation so you're trading with institutional flow rather than against it. Add to strength so you compound gains in trades that are working rather than averaging down in trades that are failing. Let the market take you out so emotion doesn't sabotage your exit timing. Own your process completely. Write these 5 gates down. Print them out. Put them where you can see them before every trading session. Make them so automatic that you couldn't violate them even if you tried. Because in the heat of the moment, when real money is fluctuating and your heart is pounding and FOMO is screaming in your ears, you won't have time to think. You'll only have time to execute what you've programmed into your subconscious through repetition. If this model clicked for you, if you felt a fundamental shift in how you view market participation, your next edge isn't found on any chart or indicator. It's mastering the psychological warfare that happens between your ears when real money is on the line. Because knowing what to do is the easy part. Doing it when your screen is flashing red and your account is swinging thousands of dollars is where the real battle is fought. In the next lesson, we'll break down the fear of pullbacks so you can hold these pyramided winners longer than you ever thought possible without losing your nerve or your discipline. That's where fortunes are truly made or lost.